This is a long form video supporting my white paper, which is an introduction to private real estate investing. There's two big takeaways I want you to take away from this video. So the first one is me as a novice investor. Over the last 6 years, my private real estate portfolio outperformed one of the top hedge funds in the world, Bridgewater Associates. A lot of people consider Ray Dalio the top investor in the world. It also 3x'd Berkshire Hathaway, the public US stock, and it almost 4x'd the Vanguard S&P fund, which a lot of the active fund managers and guys that I know that used to work on Wall Street, would recommend something like that, something Charlie Munger recommended, which is a low-cost indexed fund. So the first thing I'm going to show is just how much better my private market investments did relative to the public comps. And this was during one of the strongest bull runs for the S&P in the history of the country, yet private deals were still significantly outperformed that. So that's the first thing. The second thing I'm going to explain is that wasn't due to my expertise. I'm not touting my own expertise. In fact, I'm suggesting the opposite. I knew nothing when I started 6 years ago. I knew absolutely nothing. I got lucky. I got introduced to a couple mentors who were good at this, who knew how to invest, and I just co-invested alongside them. They made a little bit of money, but on the other hand, I almost 4x'd the S&P with that decision to get into the private market. So those are the two main things I'm going to talk about today. I'm going to be sharing my screen quite a bit. Like I said, this is in support of a white paper. So the advantage of watching the video is I'll have up some of the references that I used that are listed in the white paper. So I'm going to go ahead and share my screen here, and I'll talk through this. I'll kind of just talk through the white paper while I share my screen. And I'm actually going to kind of just read this so that you actually get kind of the full impact of the story, which I wrote. The white paper is a story. So, an introduction: the unseen perils of conventional wealth management. For those of us who did not inherit a trust fund or a family financial manager, navigating the world of wealth management can be a daunting task. Amid a sea of friends boasting about their investment strategies and self-proclaimed social media experts in everything from crypto to real estate, it's challenging to know where to start. Once you do, you realize you are at an impossible disadvantage. Now, I'm just going to talk through the white paper and some of the data points here. So since the 80s, the most profitable 10-year period for the S&P was 90 to 2000 at 37%. And the most profitable 30-year period for the S&P was 87 to 2014, which was 22%. And with both of these, I have the resources. I just went and found S&P data and calculated this on my own. Given that data, so 1990 to 2000 was an amazing decade, and 87 to 2014 was an amazing decade. When I look at that, it makes me realize why baby boomers are so intent on recommending investing in index funds, and that's what you want to do. That's what you should do if you want to retire. It makes sense why they think that. And it makes sense where Dave Ramsey got his strategy. You want to be in index funds. You want to be diversified in the stock market to grow your account. It makes sense why they're saying that, because they were able to realize the bulk of those time periods, the bulk of the growth in the S&P, and those were unique times. Now, if you're not a baby boomer, right, if you're like me and you've still got a long way to go and a lot of growth needs to happen, the S&P is going to be less lucrative. All right, now that's what I'm showing on the left. Many experts are expecting an average of 6 to 7% year over year for the next decade. The last decade was almost 14%. All right, so this is an article by a Goldman Sachs macroeconomist. So this is the big thing I want you to take away. All right, all the people that taught me and are probably teaching you benefited from a great time in the U.S. market. In the last decade, our annualized returns were 14%. So it makes sense. People's accounts skyrocketed. But, these experts are now saying it's probably going to be about half of that in the next 10 years. And there are a lot of reasons for that. There's our federal debt to GDP. There's quantitative easing that started back in 2009. And there's basically all these challenges that we are going to face as a country and in our economy. So continuing with this is not an awesome chart to look at here. Right now, our federal government currently spends 16% of its budget on its debt payments, but that could grow to as high as 30% by 2033. So let me pull up that resource here. Okay, so here are two charts that I like. So this first one is from the Peter G. Peterson Foundation. So here's our interest costs, right? So right now it's about 600 billion, but 2033 could be up as close as 1.4 trillion, which is about 30% of what our current budget is right now. So not good. But 2053 could account for 35% of federal revenues. This is, of course, considering revenue growth. Could be nearly 3 times what we spent on R&D, infrastructure, and education. So, in our current political race, and here's a super interesting chart, our total debt as a nation, just how this absolutely has blown up. So this is a challenge we've never faced before. And of course, none of our politicians want to spend less, right? Even reducing the budget by a small amount is like pulling teeth. So our debt service is going through the roof. No one wants to cut costs. What's going to happen, right? What's going to happen? Either we get extremely lucky with an order of magnitude in productivity growth, or we're going to get taxed more. And there's plenty of information out there as well, but the people that get taxed the most and audited the most are those that make less than 100,000 a year. And if you want that data, I can get that for you. That was from my CPA firm. But so, when politicians are telling us like, hey, the middle class is not going to get taxed, they're going to get taxed. The reason for that is because the upper middle and the wealthy classes, they have CPAs, they have the strategy. They can hire people to figure out the tax code and mitigate whatever's going to get thrown at them. So we're going to get taxed more. And the S&P is going to grow at 6%. So this is just overall bad. Bad is from a macroeconomic standpoint from anyone who wants to grow their retirement account. The other thing I want to finish with is you might think, okay, this is really challenging, but so I'm just going to hire a financial manager, right? I'm going to hire someone to figure all this stuff out. I have a ton of sources about why you don't want to be in actively managed funds, right? Why index funds are better. But a quick data point is less than 10% of actively managed funds outperform index funds over a 10-year period. So meaning generally the best thing you can do is be in something like the Vanguard index fund. And that you are probably not going to find some sort of secret bullet, someone who's going to create alpha for you by picking stocks or doing something. That is extremely, extremely rare. I have found for every portfolio, every retirement portfolio I've analyzed, and these are some of the best financial firms in the world, those actively managed funds prepping people for retirement are underperforming the Vanguard index fund in every instance I've ever looked at. So if you have an active fund manager, you probably want to benchmark how your portfolio is doing relative to something like an index fund. So yeah, here's just some charts. Like I said, I have a ton of resources in the article. But like here's an example. Fund type, large cap, 91% underperformed over a 10-year period. Large cap growth, 96% underperformed. So these are not good metrics as far as the actively managed funds and their performance relative to something like the S&P or an index fund. So the way I finish this section in the white paper is the nation is in financial crisis. The S&P is projected to have the lowest yields in a generation, and over 90% of professional fund managers lose. How are you supposed to win? So the next section, the allure of private real estate investing. So if you're fortunate like me, your eyes may have been opened to a new world, private real estate investing. If you consider basic supply-demand economies, private markets have a clear advantage. The number of companies listed on the U.S. stock exchange varies, but it averages about 5,000. So the number of U.S. stocks is your supply in the public market. The total public market cap is over 125 trillion. That's your demand. So in the public market, you have overwhelming demand and extremely limited supply. which suggests colossally inflated prices and low yields. If you compare this to the private market with hundreds of thousands of deals, those deals are your supply, which is a significantly greater supply, and a market cap of 10 trillion, which is your demand, it should be obvious that better yields can be achieved in the private sector. There are orders of magnitude greater supply and an order of magnitude reduction in demand. So in layman's terms, there are hundreds of times more deals, which forces those deal sponsors to lower their price relative to the public comps because there are way more deals in the private space. And there are hundreds of times fewer capital commitments in the private space relative to the public space, right? 125 trillion public, 10 trillion in private. So what that means is there's way more opportunities and your money is way more valuable to the sponsors. So that should suggest to you better yields, better investment yields in the private space. And what I'm saying now isn't new, right? This paradigm shift isn't new. More and more institutional capital, hedge funds, endowments, and pension funds are diversifying into private markets. And I'm going to pause here to pull up a couple of those articles. So I'm not going to read through all this, but just here's a couple sources. Here's one from Connection Capital, talking about the growth of private markets, what's fueling this. So diversification, superior returns, which I alluded to. This marks private assets under management at 11.7 trillion. I said 10. I haven't been able to find an exact number. Again, so institutional investors are turning to private markets. 72% of respondents are going to increase their allocations to private equity. And I'm not quite talking about private equity. I'm more in real estate, but a similar principle. Yeah, 12 trillion here. So some different numbers about what the total of it is. 40% of capital invested in the US has doubled since 2009. So all you really need to do is Google institutional shift to private markets, and you're going to see the change, right? And there's articles coming out. You can also read the prospectus, the 2024 prospectus of BlackRock, or you can look at prospectuses from things like endowments or various pension funds, and you'll see people are shifting to the private market, and it's for the things that I mentioned, right? The things that I mentioned in the first two parts of the white paper. It's not a surprise. So in the second part, I talked about the allure of private real estate investing. The third part of the white paper is reality check. This was too good to be true. So although private markets present immense opportunities for the retail investor, they come with their risks. Filing requirements for sponsors and capital raisers are subject to less scrutiny by the Security and Exchange Commission, SEC, heightening the potential for unethical practices. Continuing with the advent of equity crowdfunding and online platforms, anyone with an idea can raise capital for a deal, and vetting sponsors for quality can be a daunting task. The market is opaque and full of disinformation. Now, I'll go back on screen for this section. So the first two sections rooted in data and can basically be backed if you just go and read something like a prospectus from any of the big institutional players that I mentioned. This part is my own experience. This is different than what most people are going to tell you that are private real estate investors. This is me trying to get ahead of the curve and identifying trends that I think are going to be mainstream 5 or 10 years from now. So the first thing I've observed is all these experts out there, and it's disgusting, man. I just went to like a Christian business conference and they tried to sell me a course on picking stocks and wholesaling real estate. These are guys that made their fortune decades ago trying to sell this. I'm just going to say it was trash. And it's really sad. And if you Google like real estate conference in my area, it's probably going to be one of these people, but they're experts where you can see they quickly shift their business model out of operating, out of investing, and into educating. All right. Their primary income producing activity is no longer investing. It's making money from you, not the market. It's selling content. It's leveraging their past accolades to sell you an outdated business model and an outdated strategy. That's the first thing you need to look out for in private markets. The second one is if you go and just Google like invest in real estate, there's going to be all sorts of stuff. All right. You're going to find platforms, and some of those platforms aren't very bad, but they basically just offer kind of a two-sided marketplace where they bring in sponsors who pay to be on the platform. That would be like a Yield Street. You'll find these equity groups. So the equity groups are actually my preference for this, but a lot of times you'll get directed directly to a sponsor. So a sponsor is someone who's actually putting on the deal. So they usually have boots on the ground. They're actually doing most of the legwork. So the challenge is if you try to go direct to a sponsor, what I've found is those sponsors are so deep in the business, so deep in the operations, they are unable to pull themselves out and see the bigger picture, right? They're not looking at macro. And it makes sense. Like if you're a sponsor and your thing is you're doing like commercial real estate in Texas, you're not going to pull out and look at migration patterns to Florida, right? You don't have that ability. So you want to look for people that are multiple levels removed and can kind of see the bigger picture. But if you just go try to do this yourself, it's going to be tough to find those people. So that's the second thing to watch out for. The third thing, so investment groups. I'm in a lot of these investment groups, and it seems great. Everyone's trustworthy. Everyone gives you advice until you realize everyone has an incentive or an agenda. I've personally been in multiple groups. I've been offered to be in multiple of these mastermind groups where the common practice is basically just to blindly refer your network to these other sponsors. And it's absolutely disgusting. You know, for me, I'm really passionate about helping veterans. I'm passionate about helping people that work hard, that, you know, I have a lot of blue collar friends all over the place and friends back in Pittsburgh. So the notion of referring people like that to these sponsors I haven't personally vetted and qualified is absolutely disgusting, but you'll see that that's pervasive throughout the space. And referrals for large, and the reason for that are referral fees is, like I said, you don't have to be licensed to refer people to private vendors. So you can get these referral fees, right? With no qualification, no accountability. And it's pretty common in the space. The fourth thing that really drives me crazy is there's all these people out there saying, you know, buy houses and retire on the cash flow. You know, I've had a portfolio for 6 years and I talked to a lot of people and I look at a lot of numbers, and I've also flipped multiple houses myself. So the thing that's frustrating for me is I don't think anyone's doing the numbers, right? No, nobody. There's two different types of there's three different types of cash flow. You know, if you're going to look at a traditional cash flow statement, there's cash flow from operations, cash flow from financing, and cash flow from investing. I'm just going to forget about cash flow from investing for now. But so if you take a look at a house and think about that like a business, cash flow from operations means your rental income minus your expenses. Simple. And that's what people tout is cash flow. Cash flow from financing means your house goes up in price and your mortgage goes down and you can refinance or you can sell, right? I've never seen anyone other than me compare those two different cash flow sources and figure out what the percentages were and what the ratios were for the last decade. For me, over 95% of my gains have been from refinancing. And when I take a look at my whole portfolio, all of my houses, if my prices didn't go up, right? If it just flatlined, my cash flow from operations were barely profitable, let alone consistently producing cash, right? I made like a couple $1,000. That's it. Because what happens is, sure, you cash flow every month and you get these little chunk of change, but then you have a tenant turnover, right? Then you have a $5,000 expense that's going to eat all that cash flow. And if you've owned a house, you know that should be expected, right? Anyone who owns a house knows how expensive it is to maintain major systems over time. But nobody's saying that in the real estate investment space except me. I'm the only one I've ever heard say it like that, with that level of vindication, I guess. So those are four things to watch out for in the private market. So this next section, now it's not all that bad. All right. So despite its flaws, leaping into private real estate will leave you changed, and there's no going back. So having gone through this cycle myself, there are a few takeaways from my portfolio that I'm going to show you and validate. That although there's all this bad stuff, there's still a lot of good. Okay, so this first thing is my actual portfolio benchmark. So what I did is I looked at four deals I've done. So I've purchased three turnkey properties and a multifamily deal. Over here in the blue is the time periods when I held those. And what I did is benchmark those against some comps. So like the public comps were really the only ones I could get consistently for the exact time period. So I took a look at like Berkshire from 2018 until current. That's the time that I held this property as an example. So like that was about 12% Berkshire. And then here's, what like the Vanguard 500 did. And here's what, example of REIT did. So these are the comps that I chose, these three comps over the exact same time period. So we can see with one exception, right? Like Berkshire made an amazing trade. This was only, you know, maybe 5 quarters of a trade. So in the short term, you actually see a lot of this. In the short term, you see these kind of actively managed funds and things like that do really, really well. But we can see over 6 years, owning a house absolutely crushed. All these public comps. And then down here, I wasn't able to get the exact time periods, but just from a couple sources, I found that Bridgewater has done about 18% over 6 years. Realty Mogul is one of those platforms I was talking about. Their average IRR is about 17%. CrowdStreet is another one of those platforms, so they're about 20%. But so my portfolio as a whole, the IRR is about 32%. So doing really, really, really well relative to public comps. In the S&P average, people talk about it is about 10%. Just stop the share here. So that's the first thing. And again, I'm not saying that I knew a bunch. I didn't know anything, right? I got lucky. I was introduced to a mentor who told me investing in real estate was a good idea. I trusted him and I did it. I didn't know anything 6 years ago. Now I like to think that I know a fair amount, but back then I didn't make good decisions. This is just reflective of the fact that I was fortunate enough to play a different game, right? I didn't go try to pick stocks. I didn't go hire a financial manager. I didn't do crypto or any of this crazy stuff. I chose to invest in passive real estate, and I basically 3x'd what some of the best active fund managers were able to do over that same time period. So that's obviously a good thing, right? And it gives me the confidence I can go recreate that, and I do a lot of analysis and I have a lot more deals available to me now. The second great thing about the private space is, like I said, there's a lot of trash out there, but you can find ethical and really intelligent individuals to collaborate with. And I feel fortunate that I have some of those. So, I can go to those people for advice and feel supported in my journey with them to build wealth. The third thing is when you think about the public market, it's a zero-sum game, right? You basically have the S&P. Above that, you have winners, and below that, you have losers. You are competing against algorithms. You're competing against people that have been doing this for 20, 30 years. You're competing with fund managers with multi-million-dollar salaries in their fancy cars and their fancy suits on Wall Street. And that's your hard-earned money, right? And that's your hard-earned money that is probably losing in that game. So like I said, public markets are zero sum. Privates are not a zero sum, right? The private market is just an inefficient market. So there's all these people that have quality businesses or quality deals that are willing to offer really strong yields. It's just the private market is so inefficient, they can't be connected with all these investors who should pull their money out of public markets and invest in them, right? Here, there's kind of a barrier to entry. There's an emotional barrier to entry. And then actually finding those private sponsors is just an inefficiency in the market. It's hard to do. The fourth thing about, getting back into why private markets are great is, there are win-win scenarios out there, like I've been talking about. And there's not just, and what I mean by that is it's not like, oh, you have to find like the three people that are doing well. That's not the case at all. You just have to ignore the people that suck, right? And there's a fair amount of them, but there are a lot of quality sponsors, a lot of quality vendors. It's actually pretty easy, especially if you're going to benchmark against public options. It's actually really easy to find deals to invest in the private space. That's going to be a good option for you. And what that allows you to do is, you can achieve alpha, but you can also help people, right? There's deals out there which might be a value add acquisition from someone who wants to retire, from being a mobile home park manager or something like that. That would be an example deal we just did. There's these small family businesses who really just want to help people diversify their money. And it's just a mutually supporting relationship where you can help support, their mission in their small family business, and they can provide you consistently higher yields than you're going to get in the public space. So it's a really great opportunities for win-wins. And then the last thing is for me, it really is invigorating doing this analysis and talking to people and hearing everyone on TV and listening to all the articles and knowing that my portfolio is just dominating for doing nothing, right? I like this stuff, but I don't have to. I don't have to learn anything. Like, I don't have to read anything. I don't have to watch anything. I don't have to watch the news. I don't have to listen to all this trash on what stocks to pick. It's just, I know like two or three people that are really good at this, and we're relatively close. All I would have to do for the rest of my life is just ask them what to invest in and just do that, right? It really could be that simple in private markets. So my parting words here, and there's really two things you need to do to win in this space. So the first one, the way I talk about it is underwrite the operator, not the deal. So what that really means is, I think about this like gambling, right? If you've ever been to Vegas, there's three types of people. You have you have professional gamblers, right? Professional poker players. I know one. Let's call that the 0.1% of the people in Vegas. The big majority, right? The 99% are there to gamble. Some of them are making money, they're having fun, they're doing all these things. The 0.9% don't gamble at all, right? That's me. I do not like to gamble because I know the statistics. I know over my lifetime, since I'm not a professional, I'm probably going to lose. And I don't enjoy pulling the little slots. I don't enjoy playing poker, knowing I'm probably going to lose. I don't enjoy any of that. So I don't gamble. Right. But so when I say underwrite the operator, not the deal, is if you go and talk to people, you're probably going to talk to that 99%. Right. They're out there talking about these deals, where they're investing, what they're doing, all this stuff. They're gambling. Right. If they're not professionals, that's not valuable information. It's just not. Now, a lot of them are making money because it's really easy to make money in the private space. But think about it the same way as the people you talk to in Vegas. You'll hear ridiculous things like, "Oh no, you want to play slots at the Bellagio, not the Wynn." It's like, no, you don't want to play slots at all, unless you for some reason like just clicking buttons. So when I say underwrite the operator, not the deal, you need to find those professionals. You need to find the people whose primary income producing activity is investing and just listen to their advice. A lot of them have co-investing models. So it's the same business model that I have. What they do is, like I said, their primary income producing activity is investing. They go invest in deals and they allow people to go invest with them. It's that simple. So those are the people that you want to find. Now, when I say don't underwrite the deal, what I mean, you of course want to look at the individual deals, but your depth of experience and your breadth of exposure is going to be a challenge in actually mitigating all the risks of the private markets, because there's a lot, right? You get all sorts of exposure. You get exposure to legal that you wouldn't get in the public space. You get exposure to people and their ethics. You get exposure. You're directly connected to the success of the business. like a management company or something like that. So you get a lot more exposure than the public space. So I'd be really careful about trying to underwrite deals yourself. That's why I recommend kind of just co-investing with a private investor until you get some more experience. So that's the first thing. The second thing, and the only difference with that co-investing model I recommended, is you need to be more conservative on the risk versus reward curve. And here's what I mean by that. I was just talking to an investment group the other day. Their historical IRR is 51%. So crazy. Their strategy is they build luxury vacation commercial properties, these big commercial properties. So, over $100 million deals. They have a fund coming up. It's a 37% projected IRR. It's a 4-year build in Fort Lauderdale with 37% projected IRR. That's an example of something that's bad for you. And here's why. That carries a lot of risk. Okay, so if I'm a professional investor, typically those guys are making a lot of money, right? So that might be attractive to me because I know I can hedge that against something that's safer, right? I can hedge that against a lot of other things. So I would be okay with my level of diversification in my portfolio to take something that's risky, something that's like a 4-year build is pretty risky. So if you're just starting, don't do that. Okay. So that's the only difference that you need to do relative to a professional investor. Is what I like if you're just starting is basically 3 criteria. So the management team in place has to have been doing it for at least 10 years, right? Whatever it is, if it's an industrial facility, if it's a mobile home park, if it's apartments, at least 10 years for the management, because that's the tough part. That's the first thing. The second thing is look for value add plays. So no new construction, not for you. And if someone is going to try to tout like just bringing in your capital for an existing portfolio, the IRR is probably not going to be that high. So that's why I like value add. So 10 years of experience, value add strategy. And then the third thing is for you, I'd like to see existing cash flow, right? So this would be like an apartment building that someone's already managing, right? There's already cash flow. So they've been operating for 10 years. It's just they're going to bring in capital to make it nicer to increase rents. That calculus is way, way, way easier than something like a new build or something that's not already cash flowing. Okay, so those are my 3 criteria that I'd recommend for the second part. So that kind of wraps up the white paper and my advice. So remember, if you do take this leap, I promise you it's going to change your life, right? It's eye-opening. I'm sharing this and I'm passionate about this because of the extraordinary level of confidence and certainty I now have in my retirement account that I'm going to hit my goals for retirement now that I'm in this space and I know this, right? Like I said, I don't have to worry about all this crazy stuff. I don't have to watch all these people on the news telling me what stocks to pick. I have my network, I have the people that I go to, and I know if I consistently do this in my retirement account, that I'm going to be able to secure my retirement and my family's well-being and everything that I need to do. So the last thing is, my business model and me doing this is what I'm going to do is every quarter, I'm going to send out the best private real estate deals that I've found. These are going to be deals that I'm investing in myself. And it's going to be, kind of like I mentioned, I'm talking to a lot of sponsors, a lot of equity groups, and I'm deciding on the ones that meet my criteria that I mentioned. They have their own deal flow, right? So, in Q1 of this year, one of these sponsors might have a deal I think is the best relative to the other sponsors, but in Q3, one of the other sponsors, might have something that looks a little bit better. So that's going to be my newsletter that I'll send out every quarter. So if you're interested in being on that, you can either just DM me your email and I'll add you, or you can go to the white paper where you can actually sign up for the newsletter on my website. Be kind with the website. All right, I haven't had much time to work on it yet. I'm just really passionate about the content, so I've been pushing out content like this recently, and I haven't built the website much yet. So it's not much of a website. It's really just a couple articles, but there is a footer. you can sign up for the newsletter on the footer. So I hope this was valuable for you. And like I said in the intro video, if you have questions, I love this stuff. If you want to know anything more, if you want any of this data, I'm happy to provide that.